Hi, I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'm here today at the Strategic Real Estate Conference with Doug Moore, who just spoke at one of our panels. So Doug, tell me a little bit about the wealth transfer strategies you discussed at the panel.
Yes, thank you. One of the aspects that I spoke about and wanted to emphasize at the panel today is that commercial real estate lends itself really nicely for transfer tax purposes and estate planning opportunities for three reasons. First is that commercial real estate lends itself nicely to taking valuation discounts for transfers. Secondly, that you can get potential appreciation out of your estate for estate tax purposes, and especially in today's environment where a lot of property values are depressed with the expectation that they'll increase in value over time. And third is that commercial real estate tends to be high income producing, so this way high income producing assets can be transferred to junior family members. Income can then flow to junior family members, and the income will not accumulate in the senior family member's estate. Now there's some planning techniques that lend themselves very nicely to this. One in particular that I like to use with clients is the use of grantor trusts. Grantor trusts are established, they're irrevocable, and with a grantor trust, the trust income is taxable to the grantor, not to the trust or to the trust beneficiaries. And the benefit of this is because these assets tend to appreciate in value and there may be high realized gains, or their income is significant, so that can create ordinary income tax events. All that income is charged to the grantor. The grantor pays the income tax, so the benefit to the beneficiaries of the trust are not diminished by income tax liability. What happens is the grantor pays the income taxes and it reduces his or her taxable estate and not considered to be an additional gift for gift tax purposes when the income tax is paid. So there's that advantage. You can also couple that with a sale to the trust. Now typically what you do is you gift non-voting interest in an entity that owns commercial real estate. Because again, what happens in that situation is since you're gifting non-voting interest in an entity, you can take advantage of the discounts that for lack of marketability and for minority interest for lack of control. So you can reduce the value for transfer tax purposes. Also, if you transfer non-voting interest into the trust, the senior family member still gets to retain the voting interest of the entity and can control the entity as far as sale and entering into business transactions. So it's very beneficial from an operational point of view and from an estate planning point of view. If you couple this technique with a sale, what the grantor can also do is sell some non-voting interest to the trust, take back a note. When he or she takes back a note, what they'll do is they'll take back a note, and it may be a 9-year note, interest only with a balloon payment at the end of 9 years. If you do this transaction, for instance, in June 2012, the IRS requires a 1.07% interest rate in order to avoid any gift tax consequences. Now, if you transfer, sell property to the trust, and you take back a note, and it's discounted, this discounted property presumably will generate more than 1.07% interest on total return and yield and appreciation each year. So that arbitrage, that difference between what the assets actually appreciate in value and generate in income over and above that 1% on the note, will stay in the trust and pass free of estate and gift tax. So there's a tremendous arbitrage. There's no gift tax, no income tax consequences to the sale because it's a grantor trust. So it's enormously valuable and very effective. And there's other aspects to it, using, for instance, administrative trusts under certain jurisdictions to have an investment trustee being the decision maker as to the sale and whether the property is retained or sold inside of the trust, which lends itself, for instance, in some jurisdictions like Delaware, to allow one to do this. So there's lots of different features that can be used in this technique.
Okay, well, thank you, Doug, and thank you for speaking today. You can learn more about these strategies at wealthmanagement.com.